You know, pretty much every business that sells a physical product has to deal with this one huge question. You've got this pile of stuff you haven't sold yet. What's it actually worth? It sounds simple, but it's a really big deal. So let's dive in and figure it out. Okay, let's make this real. Imagine you run a coffee shop. In January, you buy a bunch of beans for, say, 10 rupees a bag. Awesome. But then in February, the price goes up to 14. Now, at the end of the month, you look in your storeroom and you've got a pile of leftover bags. So here's the million-dollar question. Are those the cheap bags from January, the pricey ones from February, or some kind of mix? Because how you answer that question literally changes the value of your business on paper. And this isn't just some made-up puzzle for a coffee shop, right? This is a fundamental challenge for any business with inventory. But don't worry, it's not the Wild West. You can't just pick a number you like. To keep things fair and make sure you can actually compare one company to another, there are very specific, approved ways to put a price on that pile. Yeah, there's actually a rule book for this. In this case, it's a standard called Ind AS 2, and it lays out all the ground rules. It basically says, nope, you can't just make up a number. Instead, it gives businesses a couple of really logical ways to figure out the value of their leftover inventory, or what the accountants call closing stock. And that brings us to the two main characters in our story today, FIFO and the weighted average method. These are the two big ones, the officially approved ways to solve our coffee bean puzzle. So let's break down exactly how they work. All right, first up we have FIFO. That stands for first in, first out. And the logic here is, well, super intuitive. Just think about how a grocery store stocks milk, right? They always put the newest cartons in the back and push the older ones to the front so they sell first. FIFO just assumes your business works exactly the same way. The first things you bought are the first things that go out the door. So, how does this work with actual numbers? Let's say you've got 400 units of something left over. If you're using FIFO, you have to assume that what's left is the stuff you bought most recently. So you'd look at your last purchase, let's say 350 units at 14 rupees each. Bam, there's most of your value. But you still need to account for the other 50 units, right? So you go back to the next to last purchase, which was at 12 rupees. See how that works? What's left on your shelf is valued at the very newest prices. Okay, but what if your stuff, like those coffee beans, all just gets tossed into one big bin? You can't tell which ones are old or new. Well, that's where the weighted average method comes in. It's a completely different approach. Instead of tracking individual purchases, you just kind of mix it all together and calculate one single blended average cost for everything. And honestly, the math here is refreshingly simple. You just take the total cost of all the beans you bought, let's say that's 12,250 rupees, and you divide it by the total number of bags you bought, maybe 1,000. That gives you one magic number, 12.25 rupees. From now on, every single bag you have left in your inventory is valued at exactly that amount. It just smooths out all those price bumps from before. So you see the difference? It all comes down to the core assumption. FIFO assumes this orderly queue, first in, first out. This means your inventory value on your books reflects the very latest market prices. On the other hand, weighted average assumes everything's in a big melting pot, so the value is a blend of all the different prices you've paid over time. Two totally different ways of telling the story, and believe it or not, both are perfectly legal. Okay, so we've got our two approved methods, but what about the one that got kicked out of the club? We gotta talk about the banned method, LIFO. Because honestly, understanding why it's not allowed is just as important as understanding the ones that are. So LIFO stands for last in, first out, and it's the exact opposite of FIFO. It assumes the newest things you buy are the first things you sell. The best way to picture this is a big pile of coal. New coal gets dumped right on top. And when you need some, where do you take it from? Right off the top. That old coal at the very bottom, it could just sit there for years and years. Now, for some products, that sounds totally illogical, doesn't it? So why on earth would the official accounting rulebook, Ind AS 2, explicitly ban it? What's so bad, so dangerous about LIFO? Well, here's the fundamental problem. LIFO is kind of two-faced. When it comes to calculating your profit for the year, it's actually pretty good. It matches your most recent current costs against your current sales prices, which makes a lot of sense. But, and trust me, this is a huge but, it totally wrecks your balance sheet. The value of your inventory, that pile of stuff you actually own, ends up being based on these ancient, ridiculously outdated prices from maybe years ago. And you don't have to take my word for it. The standard itself calls this out. It says that under LIFO, the inventory value a company reports, and I'm quoting here, may bear little to no relationship to recent cost levels. I mean, think about that. The number on the financial statement becomes almost meaningless. It doesn't tell you what that stuff is actually worth today. And that, my friends, is considered seriously misleading. So we've got our two legal choices, FIFO and weighted average. But there is one more golden rule we absolutely have to talk about. It's the principle of consistency. And it's what holds this whole system together and keeps companies playing fair. The rule is actually pretty simple. You have to pick a lane and stay in it. If you've got a bunch of similar inventory, you have to use the same method for all of it, either FIFO or weighted average. You can't just cherry pick, using FIFO for one batch and weighted average for another just to make your numbers look better. The only time you can use different methods is if you have products that are fundamentally different in nature or how they're used. And the rules are really strict about this. You can't just say, oh, I'll use FIFO for my inventory in Mumbai, but for the exact same stuff in Delhi, I'll use weighted average because the tax rules are different. Nope. The standard is crystal clear. A different location or different tax rules is not a good enough reason. If the products are the same, the method has to be the same. Consistency is everything. So, after all these different methods and rules, FIFO, LIFO, consistency, why does any of this actually matter? I mean, who cares? Well, we should all care, because this isn't just boring accounting theory. These choices have a direct, real-world impact on how we understand the health and the value of a company. At the end of the day, that's what this is all about. The whole point of these rules, whether it's FIFO, weighted average, or that strict consistency requirement, is to make sure that the financial story a company tells is transparent, it's reliable, and above all, it's truthful. It's what allows all of us, whether we're investors or employees or just curious, to compare one company to another on a level playing field. So the next time you're looking at a company's financial report, don't just skip over that inventory number. Take a closer look. Ask yourself, are they using FIFO or weighted average? What does that choice tell you about their business? And what story is that pile of stuff really telling you?